Hey everybody, welcome to NetPicks. Today we have with us Mike Rykse. He is our options expert. Over the last couple of months and couple of weeks, we've seen really a lot of volatility in the markets. The VIX has skyrocketed, and that's the whole point of today's conversation. Mike, tell us kind of what you've seen over the last couple of weeks.
You're so right. We have seen volatility return in a big way. We haven't had much of it the last few years, but boy, has it changed over the past few weeks. And my concern in talking with traders, they're paying so much attention to financial media and they make it sound like volatility is a bad thing. As we're going to show here today, we love the volatility. As active traders, we love the movement back and forth. We love the volatility being priced into the option markets because one of our favorite strategies is selling credit spreads. And the higher the premiums and the options, the better it is for us. So there's a massive opportunity. However, this type of a market is a big test of discipline. It's a big test of emotional fortitude, which we're going to talk about here a bit today.
You have to have an iron stomach in today's markets.
No doubt about that.
Just to for those traders who are new to options or things like that, can you give us a brief overview of why the VIX impacts pricing and why that's good for credit spreads?
So when we take a look at the VIX, in general terms, it's a gauge of the fear in the overall market. And when you start to see the VIX high, like it is now, they're pumping in that uncertainty into the option markets. And if I take a look, and I'm just going to pop up my screen here real quick so I can show. I'm going to show my trade page. I'm going to use SPY as an example here. I love to look at SPY. It's the S&P 500 ETF. If we take a look at the trade page and just look at the 0-day options, the ones that expire end of the day today. If I just take a look at the money calls and puts, we've got them pricing between $2.50 and $3.40. If I take a look 3 weeks ago, or even a month ago at this time of day, you would normally see these options being priced, $1.20, $1.50. They're way more expensive now because market makers are pricing in that uncertainty. They're pricing in the fact that we could see big moves between now and the closing bell. And as options get more expensive, it puts more pressure on needing to be right directionally. If you're just going to buy a call or a put, you're going to pay up for it right now. They're more expensive, and you need that directional movement to be right in a big way. But if it does, if it happens, if it works, you can make some really nice returns. We take a look at the flip side and say, okay, if options are more expensive now, if I sell a credit spread, I can collect more premium up front. And instead of only having one way of making money, if I buy a call or a put, I give myself multiple ways of making money because my bet is that those options are going to lose value between now and the closing bell this afternoon. I'm betting that the move is going to be smaller than what the market makers are pricing in. And by doing that, instead of just buying outright options, we're able to better stack the deck in our favor. We're just taking what the option markets are giving us and we're using the right strategy for those conditions.
I love it. So you're adapting to real-time market conditions and you're using that to kind of modify, not change your strategy, just modify it, tweak it a little bit to take advantage of these rocketing prices in options. That's a smart move. How do retail investors or professional investors focus on adapting to conditions specifically with like risk management or diversification?
Right. So there's a couple things that come into play here. First of all, if you take a look at options, by definition, they are the most flexible financial product that you can trade. You can do things with options that you can't do with any other financial instrument. Where retail traders struggle is they back themselves into a corner and they say, hey, I only want to buy options. I want to keep things simple. And in many conditions, that'll work. We will buy options on our side on a very regular basis. But I also want to have those credit spreads at my disposal because markets change. We're seeing a big shift right now, and we've seen it over the past few weeks where what was working 3, 4 weeks ago may not be working as well today. So I want to be able to adjust in the fly. I don't want to have to reinvent the wheel when markets are busy. I want to go to my playbook and say, hey, I can use a credit spread now and increase my probability of success, have a much higher winning percentage during these wild market conditions. Now, another topic that comes up right now with the VIX being high and options being more expensive is the risk management side. And I've seen it come up this week with numerous traders. A big mistake that retail traders make is they trade a similar number of contracts in every trade. Let's just say they use a standard 10 contract position size. Well, trading 10 contracts today is very different than trading 10 contracts 3 weeks ago. If we go back to our example here that we just took a look at, if I take a look at those at the money calls, trading at around $3.20, well, 3 weeks ago, this time of day, it might have been $1.50. So now, if you're using a standard 10 contract position, your risk is much higher today than what it was 3 weeks ago. And that's why for us, with our students, we really preach using a set dollar amount of risk on every trade. Let's call it $500.
So
So
you
if you're
use dollars instead of contract counts. So if the contract prices have doubled, you should cut the number of contracts you're trading in half, essentially.
exactly one of the issues that I've seen come up multiple times this week with traders is that they're not seeing that difference in the premiums. So they're trading the similar 10 contract position, not realizing that their risk is close to double what it was just a few weeks ago. Very, very important to adjust position size accordingly right now. Use that set dollar risk. That's going to be a huge benefit. You're going to see far more consistency. And I talked about this with our traders this week. What you think is trading small can turn very big if you're not careful in these types of markets. So really important to pay attention to position size right now.
I think that's a great takeaway for all traders, whether you're professional, beginner, or somewhat experienced, is to keep your position sizing stable and calculated on a dollar basis, not on a contract basis. Now, you mentioned something about diversification in other ways. What are you looking at there?
So diversification, a lot of times people hear the term and they think, hey, I'm just going to mix up my markets, mix up different sectors, different stocks. And that's a big part of it. But we also love to mix up the strategies that we use. So if I take a look at my own personal trading this week, I've taken some day trades. I've taken some swing trades. I've traded stocks, ETFs. I've taken some long options. I've taken a number of credit spreads. I'm mixing it up. And the more layers of diversification, the better off your results will be long term. If I take a look at my day trades, the last 3 weeks, this volatility has been phenomenal. We haven't had a losing session on my favorite market, which is the NASDAQ ETF. We haven't had a losing session in 3 weeks. That's phenomenal. On the swing trading side, it's been a really nice stretch for us. Hasn't been perfect. We've had some losing trades, but the volatility has really provided better conditions for us and what we look for. So highly recommend that you, instead of just going all in on one or two big positions, spread out that risk. Take 5 or 6 very small positions, get different types of trades on, different markets. That's going to have a huge impact on your equity curve over time.
I think that speaks directly to traders' education levels as well, right? If you only know how to trade long or short options, that's going to really hinder you. Being able to trade different types of strategies, knowing different markets, understanding that, you can widen out your trading styles in markets like this is going to be critical for every kind of options trader out there. Mike, let me shift gears here just a second and talk about something that a lot of people don't think about. In today's market, people are attuned to the charts and the numbers, but they don't really talk a whole lot about emotional reaction. I know right now with a lot of emotions running high on the political side, you see news coming out every day, love it or hate it. You're seeing a lot of this visceral reaction to what's going on in the world. How do traders kind of rein that in and control their emotions to make sure that they're stable when they're putting money to work here?
Yeah, I think there's a couple of very crucial points on this topic. First of all, when I'm going through a trading day, I limit distractions. I don't want to take a look at CNBC, Fox Business. Doesn't matter what the source is. I don't want to be distracted because they're in the business of selling fear, right? They want eyeballs on the headlines, and they're going to push that fear narrative. And you're going to hear a lot of talk over the weekend, over into next week. You're going to hear a lot of talk about going to the sidelines, going into cash. And for me, I couldn't disagree with that more. I look at this as a massive opportunity as an active trader. I want to take advantage of this. We thrive in these types of conditions. So eliminate the distractions and focus on staying disciplined to your system. We are big believers in having that trading system in place. And when we talk about trading system, we're talking about a rule set that's going to guide all of your trading decisions. Where you get in, where you get out, how you manage the trade from start to finish. Really important to have that in place because if you don't, right now, these moves are big enough what was taking weeks to happen is now happening in a few hours. It's very easy to get caught up in overreacting to every little move back and forth. If you've got that disciplined rule set in place that you're following, it really helps minimize that emotional aspect. Let's face it, the emotional aspect is always going to be there, right? We all have our hard-earned money on the line, but I want to have a rule set in place that can minimize those emotional decisions. And we had this come up in our trading room here today. It's really easy to look at these markets and say, hey, I just want to take trades all day long. And it's very easy to overtrade, thinking, hey, if I don't catch every move, I'm missing out on an opportunity. Well, part of our approach at NetPicks is we're very disciplined to our rule set. And one of our rules is what we call our power of quitting approach. And what I'm looking for there is I'm saying, okay, let's let the numbers dictate everything that we do. If the numbers back up looking for one win a day on the day trading side, let's focus on executing that plan. And when I book that one win, I don't care what happens in the further or in the next few hours of the session. If I book my profit, I'm done. And that prevents overtrading. It prevents overtrading to the point where you give back all that profit, and then all of a sudden you're looking at a losing position at the end of the day.
That's perfect. Take your win, go home, enjoy life. Don't worry about the markets. Come back and trade another day. Fantastic advice for traders of all types. Mike, in our notes when we were talking a little bit before we started recording, you mentioned a couple of things of markets of interest, things that you were seeing that was interesting, specifically within two areas that caught my eye. One was tech, and then the other one was silver and gold. Can you talk to me a little bit about, you can't get two dissimilar types of markets, commodities and technology. What are you seeing there?
Well, it goes back to the topic of diversification. I want to mix up my markets as much as possible. But as active traders, and when I talk about being an active trader, what we classify that as is looking to take positions anywhere from 24 hours on out to a few weeks. That's what we classify as swing trade. So I want to be active. I want to go to products that have a track record of moving on a regular basis. So Apple, Microsoft, Nvidia, Tesla, these are names that are in the headlines. They're active on a regular basis. They have great liquidity in the options. And if we take a look at that whole list of the tech stocks, and I'm just going to pull up a quick chart here a second. And we'll take a look because there's a lot of these patterns setting up where you've had big moves. Here's Amazon. You've got this big move to the downside. If I take a look at my pulse indicator down at the bottom, that's giving us a 2 standard deviation move on the downside. What that's telling me is we're at a point of interest that historically has led to either a period of consolidation or even a bounce in the other direction, in this case to the upside. So this gives me an interesting opportunity over the next week or two where I could potentially look at selling a put spread, looking for a bounce to the upside, not expecting a huge follow through back up to all-time highs, but I'm just looking for a bounce over the next few days, right? So if we take a look at Apple has actually gotten through the last couple of weeks in a pretty decent pattern, right? We have not had that big move to the downside. So I'm looking at that as a potential area of relative strength. We know Apple's a big part of the index markets. It's a big driver of this market. So if we start to see Apple bounce over the next week or so, the rest of the market could take its cue. One more name, if you take a look at Tesla, you're seeing a lot of these oversold conditions. Now I have some yellow bars popping up on the pulse. When I see yellow bars, it tells me we're past a 1 standard deviation move on the downside. Doesn't mean we can't move lower, just means it's not statistically probable. And you typically will see a bounce out of that pattern. So I'm looking at tech over the next week or two, looking for some bounces in the near term. Do I expect a big bottom to be put in place? Big picture? No. I think we're going to see some further weakness in the months ahead. But at least in the near term for a trade over the next few days, it's an interesting opportunity. Now, gold and silver, on the other hand, if you take a look at the metals, in a lot of cases, those are looked at as safe haven markets. When there's uncertainty in equities, in many cases, people will go to the metals. Gold has had a very big move to the upside. It's been phenomenal. If you take a look at GLD, this is the gold ETF. It's been a really impressive move to the upside. So we've been playing it with our members. I plan on being active most of the year on gold and silver, but I think silver gives us a more interesting opportunity here over the next few weeks. We don't have a position on, But I believe silver has been building energy in this range. If you take a look at this chart, between 29 and 30, we've just kind of been stuck here the last few weeks. I believe we're building energy for another big move out of this pattern. So I think this one is of interest over the next week or two. We'll most likely have a position on with our members.
And you know what's interesting to me is that this is a sign of the technicals lining up with a lot of the fundamentals that are happening. A lot of that fear-based activity happening in the news cycle right now, like you said, is driving people to look at silver and gold as, a natural safe haven. And here you see the technicals showing that exactly as kind of a level of support for these types of trades.
Absolutely. I think there's a big opportunity here. But I think it's really important to point out too that you need to be open to trades in both directions. Right? A lot of times people ask, are you bullish? Are you bearish? What are you expecting months on out? I'm not concerned with what's going to happen months from now. I'm looking for opportunities in both directions. If I take a look at our positions on gold, some of our positions on the tech names, we've had both bullish and bearish trades on over the past few months. So to be open to trades in both directions is very, very important. Don't back yourself into a corner and become a perma bull or a perma bear. Be open to opportunities in both directions. That's a big advantage for traders going forward.
I love it. So the last thing I want to talk about before we wrap on today's call is the SPY. You mentioned that there were areas to watch and looking at some interesting factors. What are you seeing when you see the SPY?
Well, SPY is the most liquid product in the world on a daily basis. It's got great liquidity both in the stock and the options. There's just a tremendous opportunity weekly. And what I love about SPY is it has daily options. We have Monday through Friday expiration cycles on SPY. It gives us a lot of opportunity for what we call our overnight pop trade. This is a trade that we're looking to open up at 3:50 p.m. Eastern time, 10 minutes before the equity close, and we're looking to close these positions out the following morning. So we're in and out overnight, very short-term trades, and we're utilizing the credit spreads again to give ourselves multiple ways of making money on the trades. And here's a trade from earlier this week on SPY. We had a short setup. You can see this red dot on our charts, what we call our thrust trade. We're seeing price roll over to the downside. We're seeing price, our red indicator, it's our thrust indicator, breaking below the midline of our channel. So we're seeing a short opportunity there. And we saw that into the close Monday afternoon. So we came in and we sold the 586, 588 call spread. So we're trading two options at the same time. The whole goal is for the stock to stay below 586. We made money on this position five different ways. Up, down, or sideways, as long as the stock stayed below 586, we were okay. We also benefited from the time decay adding up, which that close to expiration, the time decay is extreme. That was helping us. And then we also made money if volatility decreased. That didn't happen, but we did get the directional move and the time decay adding up in our favor. We collected $60 per spread on this trade. It tied up $140 of our capital per spread. That's our max risk on the trade. Everything that we do is fully risk defined. So if I am dead wrong and the market moves against us, I want to know what my max risk is right up front. In this market, I think that's incredibly important. It's really important to manage the risk in this environment. So the very next morning, you can see, was it a fall out of bed move? Did we see the market collapse? It didn't, but we didn't need it to. We were able to close it out, book a $30 profit. That's a 21% return on our capital in and out overnight, move on with the rest of my day. It's one of my favorite trade types. It's $90 a profit if you're risking $500 per trade. Very doable regardless of your account size. These are the types of trades that we're looking for on a regular basis. If I take a look, the question I get most frequently right now is, Mike, what is your approach done since volatility has exploded?
Yeah.
Have things broken down? Are you still seeing consistent returns? If I take a look at the OPT, if I just take a look at the last 20 trades, so that takes a look at the past few weeks since volatility really started to pick up. We have had 16 wins and 4 losses. So
Wow.
it's done really, really well in this period of uncertainty where a lot of people are pulling their hair out saying, what is this market going to do? We're staying consistent to a rule set, and that's made a huge difference for us. We're able to generate the consistent returns regardless of what the market is doing. And these are opportunities that we're looking for each and every week.
So you're able to capitalize on these changing market conditions. You're, implementing obviously very smart risk management strategies. You're really focused on trading your systems, and you're not wildly trading about. You're following your rules, and it's resulting in win after win. I love to hear those kinds of stories. That is absolutely fantastic. Mike, any other parting comments before we call it a day?
Yeah, I think it's what we've been talking about today. Just the discipline is so important in this market. Guys, don't be scared to the sidelines. There is a tremendous opportunity here for those that are disciplined, that have the system in place. And if you would like to connect and discuss that in more detail, I would love to reach out. My email is mike@netpicks.com. Feel free to send me an email and we can connect. And I'd love to help you out navigate through these interesting markets.
Awesome. Thanks for your time, Mike. We really appreciate it.
Thanks, Brian.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.